As of the latest market session on August 5, 2026, NUBURU, Inc., trading under the ticker symbol BURU on the OTC market, closed at $0.06375, marking a single-day rally of more than 20% on heavy volume, topping 11 million shares. While most market participants glancing at a penny stock trading around 6 cents see nothing more than a speculative ticker clinging to life after getting shifted off the main NYSE American exchange, the underlying corporate restructuring taking place behind the scenes paints a far more intricate picture. Investors following retail trend tickers on Robinhood stock trading or checking high-volume penny stock screens on the Robinhood app might assume this company is merely experiencing a temporary microcap pop driven by retail momentum. However, the reality reveals a complete architectural overhaul of the company's core operations, financial obligations, and target addressable markets. The consensus market narrative around NUBURU has long been defined by financial distress, dilution, and the painful path from a specialized industrial hardware maker to a microcap struggling for liquidity. For months, traders using self-investing accounts, checking charts across popular investing sites, or executing orders through an individual brokerage viewed the company as a textbook example of a cash-burning laser startup that ran out of runway. That expectation was not unfounded. Repeated capital raises, heavy operating losses, and a falling market cap culminated in NYSE American non-compliance notices and an eventual move to over-the-counter trading. Yet the recent surge in trading volume and sharp price action point toward a stark divergence between past perception and present execution. If you examine recent tape action on Interactive Brokers stock trading or track institutional movements via Fidelity Investments, you will notice that the trading environment surrounding NUBURU has changed dramatically. The fundamental driver behind the recent spike in buying activity is not speculative hype, but the receipt of official Italian Golden Power clearance. This regulatory approval granted authorization for NUBURU Defense LLC to acquire a 70% controlling stake in Techne S.p.A., a recognized European defense engineering firm. For a microcap enterprise whose previous market capitalization was hovering in the single-digit millions, gaining regulatory clearance to integrate an established defense engineering business with a substantial signed order portfolio completely alters the forward-looking balance sheet math. To put the current trading dynamics into context, consider how retail traders on the SoFi trading platform or Interactive Brokers platform usually approach low-priced securities. Most market participants look for short-term technical bounces or quick momentum trades without digging into filings, but analyzing the actual transactional structure reveals how management funded this acquisition framework. Just days before securing the regulatory clearance in Italy, the company closed a $38 million public offering. Instead of using those funds solely to keep lights on or cover overhead, management immediately applied a massive portion of that fresh capital toward extinguishing debt. They wiped out approximately $16.75 million of outstanding principal obligations, including a $15.5 million debenture and subordinate notes. Clearing those expensive debt instruments eliminated monthly cash amortization pressure and stripped away burdensome equity line covenants that previously forced continuous share issuance. For retail investors using online investing platforms, whether managing a portfolio through Fidelity Brokerage, checking account balances on SoFi Active Investing, or monitoring positions via Schwab Intelligent Portfolios, debt elimination is one of the clearest signs that a restructuring is transitioning from theoretical promises to concrete balance sheet mechanics. The removal of that senior debt overhang gives the business an opportunity to reallocate capital directly into operational expansion rather than debt service. At this point, I want to hear from you. Comment below how many shares of NUBURU you currently hold, or if you're avoiding microcap restructuring stocks entirely in the current market environment. Understanding where NUBURU stands today requires taking a step back to evaluate how the enterprise was originally built and where its legacy assets fit into the new picture. Founded as an industrial laser manufacturer, the company focused on pioneering high-power blue laser technology designed for welding copper, aluminum, and critical reflective metals to electric vehicle battery production and consumer electronics manufacturing. In theory, as megatrends in electrification accelerated interest in megacap technology names like Tesla stock, industrial supply chains were expected to buy specialized manufacturing machinery. However, commercial adoption proved much slower than anticipated. High equipment costs, protracted customer evaluation cycles, and severe capital constraints prevented the business from scaling its standalone laser manufacturing line into profitability. Recognizing that the original pure-play laser model was consuming cash faster than it could generate commercial revenue, executive leadership initiated a radical strategic pivot. Over the course of recent quarters, the organization began transforming itself into a broader defense and security platform. Rather than selling components into slow-moving industrial supply chains, management began consolidating defense-oriented technology entities. The consolidation of Orbit, the acquisition of Lycon, and the pending majority acquisition of Techne represent a structural transition toward high-margin defense systems, specialized electronic warfare hardware, and government service contracts. This directly addresses the historical gap between investor expectations and financial reality. In earlier quarters, revenues were nearly non-existent, often dropping into the low hundreds of thousands of dollars, while quarterly operating expenses ran into the millions. First quarter reports for 2026 showed early signals of this operational turn, with top-line revenue showing initial contributions from software subscriptions, maintenance services, and specialized product deliveries. More importantly, stockholders' equity moved back into positive territory, recovering from a severe equity deficit recorded at the end of the prior fiscal year. When evaluating stocks on Interactive Brokers stock screens or reviewing options chains on Robinhood stock trading, investors frequently draw comparisons to high-growth tech leaders or large defense contractors. However, microcap defense turnarounds operate on entirely different mechanical rules. Large-cap tech companies trade on price-to-earnings multiples and massive cash flows, whereas a penny stock in the middle of a turnaround trades almost exclusively on cash burn rates, balance sheet survival, and contract execution milestones. For self-investing enthusiasts using intelligent portfolio tools or seeking online investing advice through specialized investing sites, tracking a stock like BURU requires analyzing specific catalysts. The primary near-term catalyst is the formal closing of the Techne transaction. Techne's business plan outlines a substantial long-term value of production framework and a multi-million-dollar residual order portfolio. If fully integrated, those revenue streams could fundamentally change the scale of the consolidated business, elevating it from a microcap R&D shop into an active defense supplier with predictable cash inflows. However, a complete analysis must weigh the significant risks that remain on the table. Despite recent progress in debt reduction and regulatory clearance, SEC filings continue to highlight going concern warnings from auditors. Operating cash flows remain negative, and the business remains dependent on successful execution of its integrated platform strategy to achieve self-sustaining operations. Additionally, trading on the OTC Pink market carries inherent liquidity constraints and higher volatility compared to major exchanges. While management has indicated plans to seek listing compliance and pursue exchange upgrades over time, those outcomes depend on meeting strict market capitalization and stock price thresholds. Investors utilizing tools like Fidelity Trading Platform, Fidelity Mobile App, or SoFi Robo-Advisor must recognize that microcap turnarounds are double-edged swords. The gap between expectations and reality creates massive volatility. If the market expects total failure and liquidation, even modest execution on contract delivery or debt elimination can trigger dramatic rallies, as seen in recent trading sessions. Conversely, if integration hits regulatory delays or operational hurdles, share prices can drop quickly due to thin trading volumes on over-the-counter venues. For those managing wealth across individual brokerage platforms, Fidelity IRAs, or Robinhood cash management accounts, position sizing and risk management remain the most critical considerations. Speculative microcaps undergoing strategic shifts require rigorous monitoring of quarterly cash burn, contract execution, and shareholder dilution metrics. Watching how institutional investors and mutual funds adjust their holdings on Fidelity ETFs or Interactive Brokers platform will provide key signals regarding long-term smart money confidence. In closing, the story of NUBURU is a study in expectations versus reality. The broader market spent months pricing the company as a failing industrial laser manufacturer overwhelmed by debt and exchange listing challenges. The reality unfolding today is an aggressive pivot toward defense technology, backed by major debt cancellation, direct capital raises, and international regulatory clearance for a major European acquisition. Whether this transformation results in a sustainable long-term business or remains a high-risk turnaround experiment will